Let's jump right into this explainer. If you've been watching the tech sector even a little bit lately, you already know the race to build the backbone of artificial intelligence is moving at absolutely lightning speed. Today, we're dissecting the massive market momentum behind CoreWeave and the broader AI infrastructure space. We're going to break down the anatomy of a major analyst upgrade for them and figure out exactly what is driving this relentless, non-stop demand for AI computing capacity.
$100 billion. Let that sink in. CoreWeave is currently sitting on a staggering revenue backlog nearing that exact mark. And look, that's not some pie-in-the-sky projection for a decade from now. We're talking about contracted, committed revenue just waiting to be realized. It's a massive, massive figure. And honestly, it really highlights just how desperate AI-native companies, hyperscalers, and global enterprises are for purpose-built infrastructure. When a company has that level of visibility into its future revenue stream, well, it fundamentally changes how investors and analysts view its entire trajectory.
But you know that massive backlog brings us to a really fascinating question. Why is Wall Street so incredibly bullish on a company that's planning to spend up to $35 billion in a single year? I mean, that is an eye-watering amount of capital expenditure. The tension here is almost palpable. You've got this historic, unprecedented revenue visibility on one side, and then these absolutely massive margin-crushing infrastructure investments on the other. It is a high-stakes balancing act. So to understand why the market is cheering them on, we need to look at a recent major catalyst.
Section 1. The BNP Paribas Bullish Upgrade. So the stock actually saw a really solid 4% pre-market pop following the specific initiation of coverage. BNP Paribas slapped an outperform rating on CoreWeave and assigned a price target of $192. Now, coming right on the heels of a 14% surge just the day prior, this upgrade essentially poured gasoline on the fire. It wasn't just a polite nod of approval, right? It was a massive vote of confidence that CoreWeave has positioned itself literally perfectly within this rapidly expanding AI infrastructure market.
What's really interesting here is the exact phrasing used by BNP Paribas analyst Stefan Slawinski. He literally called CoreWeave one of the most strategically important companies within the AI infrastructure ecosystem. Think about that. He isn't just saying they're a good business, he's framing them as an indispensable player. They sit right there in the middle, between the silicon, like Nvidia's GPUs, and the actual AI models themselves. They're delivering the specific infrastructure, the software, and the expertise needed to actually build and run AI at scale.
So let's break down exactly why BNP Paribas is so optimistic. Slawinski highlighted a really powerful combination of factors. First off, their sheer scale of operations. Second, as we just talked about, that incredible contractual revenue visibility. Third, their differentiated software capabilities. You see, they aren't just renting out hardware. They're actually optimizing the entire stack. And finally, their growing efforts to move up the AI value chain through managed inference services. As the market shifts from just training AI models to actually running them, what we call inference, CoreWeave is proving they've got the exact setup required to handle those continuous, high-performance workloads.
Section 2. Revenues, backlogs, and rising costs. The explosive demand we're talking about here is just undeniable. Back in the first quarter of 2025, CoreWeave brought in $982 million. Fast forward exactly 1 year to Q1 2026, and that number more than doubled to $2.08 billion. In fact, the CEO, Michael Intertrotter, actually noted this was the strongest bookings quarter in the company's entire history. That top-line growth is absolutely off the charts. But okay, here comes the reality check, and it's a pretty significant one. Aggressive expansion means massive, massive spending. CoreWeave's net loss for the quarter actually expanded to $740 million, and that's up from $315 million the year before. Just their interest expenses alone surged to $536 million. To keep up with that $100 billion backlog, management had to raise their 2026 capital expenditure guidance by a full $1 billion. That brings the target range to somewhere between $31 and $35 billion. They're buying up chips, securing power, and building data centers at a blistering pace. And that means, for sure, profitability is taking a back seat to capacity building in the short term.
Section 3. CoreWeave versus the competition.
There's a really fascinating contrast in how analysts are treating these different companies right now. While BNP Paribas gave CoreWeave that outperform rating, noting the potential for a catch-up trade if management executes on their growth plan, they actually initiated coverage on a peer, Nebius Group, with a neutral rating. So why the difference? Well, Nebius's shares have already skyrocketed nearly 190% from their recent lows. Analysts feel that Nebius's current valuation basically already reflects a lot of that AI optimism, which prompts a more balanced outlook. But CoreWeave, despite that high capital burn we just mentioned, is seen as having much more runway to narrow the valuation gap with other major AI infrastructure providers as its business scales up. Section 4. Nvidia tailwinds and sector momentum. Zooming out to the broader market for a second, just look at the relentless pace of innovation coming from Nvidia. Over at Computex and GTC Taipei, Nvidia CEO Jensen Huang dropped back-to-back announcements that literally sent shockwaves through the industry. We saw the RTX Spark superchip, which is pushing AI right into PCs. We saw the standalone Vera CPU for AI data centers. And crucially, we got confirmation that the next-generation Vera Rubin AI platform is in full-scale production. This rapid-fire hardware evolution is exactly what's driving the massive infrastructure demand that CoreWeave is capitalizing on. And all of this creates a massive halo effect. When Nvidia rallies, like that 6% jump they saw right after those announcements, it creates a rising tide that lifts all the boats in the AI infrastructure harbor. Think about it. Every single new Nvidia chip requires data centers, optimized networking, and just massive amounts of power to run. So Nvidia's sector-wide momentum directly reinforces investor optimism that CoreWeave's aggressive $35 billion capacity build-out isn't just justified, it's absolutely necessary. Section 5. The long-term AI outlook. The absolutely crucial point here is how they are locking in their future. Look, it's one thing to have a backlog. It's a completely different ballgame to have it backed by the biggest players on the planet. CoreWeave recently signed a massive $21 billion expanded agreement with Meta to supply AI cloud capacity all the way through 2032. They also inked a multi-year deal to provide computing capacity for Anthropic's Claude models. And on the physical side of things, they've already surpassed 1 gigawatt of active power, and they're targeting a colossal 8 gigawatts by 2030. They are quite literally securing the land, the power, and the partnerships to dominate the next decade. But of course, they aren't the only ones seeing this golden opportunity. While CoreWeave's backlog is massive, competition is heating up in a big way. For instance, Alphabet's Google and Blackstone just announced a $5 billion joint venture to create a brand new AI cloud computing company, and this one is powered by Google's proprietary TPU chips. The big money is moving in, and alternative semiconductor suppliers are racing to capture market share alongside Nvidia. So moving forward, CoreWeave is going to have to continuously prove that their specialized GPU-backed cloud actually offers superior performance and economics. All of which leaves us with this final, genuinely provocative question to ponder. We see the $100 billion backlog, right? And we see the $35 billion in CapEx spending for this year alone. But the honest risk of this entire AI trade is this. Will this aggressive, unprecedented infrastructure build-out ultimately outpace the actual real-world long-term software demand? Are we basically building a massive 10-lane highway before we even know how many cars are actually going to drive on it? It's the multi-billion-dollar question that will absolutely define the next era of technology. Thanks for joining me on this explainer, and keep your eyes on the data.